Hello students, this is a question for you. ABC company has paid a dividend of rupees 10 per share last year and it's expected to grow by 5% per annum. If an investor expected rate of return from ABC is 7%, calculate the market price of the share as per dividend discounting method. Expectation is 7% of investor and expected growth rate is 5% of that stock ABC. Calculate the price. Okay, let's do a small exercise. All right. Our expected return is 0.07 and the growth rate is 0.05. It means what? Our return from the dividend has to be 0.02. All right, 2% we should get from the dividend, and dividend is 10. Dividend is 10. All right. Dividend is 10. Oh. Let's divide it by 0.02, which has then what would be the price of the stock? Oh, price of the stock will be 500. And if it grow by 5%, 5% of this is 25. The value of the stock is 500 plus 25, which is 525. The answer will be 525. 525. This is the answer. Okay, here no price was given, but you had been given what the amount of dividend is paid and expectation of total return, that is 7%, and the 5% is the growth rate of the company. So what is the left? That is 2% from the dividend. So by using this, we have calculated the price for the stock is 525. All right, good luck, goodbye. It's a part of